Do you need to own Divo within your income and dividend portfolio? That's the question of this video. What happens if you own JEPI, which is a very high quality, relatively new income ETF? Then do you also need Divo? Where exactly does Divo fit into a portfolio? So in my last video, I asked you guys about a upcoming portfolio change I want to do. So this right here is my existing portfolio as it stands right now. And then I gave you guys 3 options right here. And based off of your feedback, it was a pretty dead even split between option 1 and option 3. And since that video, I continue to do my research, evaluating these ETFs even deeper. And I honed in on the dichotomy between JEPI and Divo. So when I continued to do my research here, I was asking the question, how does Divo compare to both JEPI and SCHD? So even though these are 3 phenomenal funds, is it a little bit repetitive to have all of them? So this is the 3-year view, the total return of these assets. And remember, JEPI comes into existence about right here, so it's not exactly a fair comparison. But even so, we can see that Divo and JEPI have very similar returns, and in fact, most of the time, Divo is doing a little bit better than JEPI. And then SCHD has more capital appreciation and thus tends to perform better over longer periods of time. And if we change the view to just the past 1 year between these 3 funds, we can see just how similar all of them are. They move in the same general direction, which makes a lot of sense. And here, in the past 365 days, JEPI has actually done the best. So that's the performance. Now, the actual construction and the methodology, to me, is also very important. So beginning with JEPI, they pull stocks from the S&P 500 using a process to identify value stocks with a favorable risk-return characteristic. Notice how there's no mention of dividend stocks, just S&P 500 stocks with favorable risk-return characteristics. And then the second part is the equity-linked notes, which help to generate additional income. Moving on to Divo, the fund's manager selects approximately 2025 outperforming dividend-paying stocks from the S&P 500 index. And then the second part, the manager technically writes short-term call options on those stocks to generate additional income. And then finally, for SCHD, this is just a market cap weighted fund. They want a 10-year history of paying dividends, and they have additional screens like cash flow to debt, return on equity, dividend yield, and the growth rate of that dividend. So zooming out to more of the big picture, we can see how Divo, at least to me, kind of fits in between JEPI and SCHD. Because much like SCHD, it does focus on actual dividend-paying companies, but like JEPI, it has covered calls and active management. And I do want to quickly point out that because all these funds are constructed differently, the similar performance they've had over the past couple of years isn't guaranteed into the future. One of these funds could easily pull away and outperform in the future depending on what the market does because they are constructed differently. Okay, and then the final data point I have here is the actual income these assets produce, beginning with JEPI over here. So this chart is the most recent dividend payments, and we can see the payment for July was actually the highest on record, and it does seem to be mostly trending upwards, and the current dividend yield is 9% on this asset. Moving over to Divo, the current yield is 4.7%, and the big criticism here is there's really not much dividend growth happening in the past couple of years, with the most recent monthly dividend being 14 cents per share, which is one of the lowest in recent memory. And that leaves us with SCHD, which has the lowest dividend yield of 3.2%. They also pay out on a quarterly basis. But here there's a clear trend upwards, and the most recent dividend payment was the highest on record. So clearly there are major differences between these 3 income ETFs, even though the overall performance has been pretty similar. And in terms of similarity between Divo and SCHD, 25% of Divo's holdings are also within SCHD, and then 6% the other way around, for a total overlap of 16%. And right here are the major differences between the two. So Divo is more heavy in these companies, and SCHD more heavily invested in these. And to give you guys a quick comment, I think all of these names are high quality. I kind of don't have a preference for one list over the other. And if you want to get technical, year to date, Divo is doing a little bit better than SCHD, with JEPI actually doing the best. So to give you guys my final thoughts here, I think JEPI has really been a diamond in the rough, performing extremely well, as we saw right here in the total return, as well as the dividend. It continues to grow and pay out a huge monthly dividend. But when it comes to Divo, the performance is similar to JEPI, although it seems to be just one step behind. But really, the big thing for me is the dividend growth rate. It's just falling behind with this ETF. And being that this dividend is essentially stagnant, and SCHD's dividend is continuing to grow, along with this most recent market rotation to the downside, that has given a nice boost to the yield of SCHD, making the gap between them in terms of income less and less over each passing month. Now, again, in my view, these are three of the best, highest quality income assets on the market. And there is a difference to the construction between all these funds. And depending on what the market does in the future, which is unknown to us at the present moment, any one of these could outperform. But the way that it's currently looking to me is that Divo is less competitive considering the options of JEPI and SCHD on the market that you could otherwise be investing in. But let me know your thoughts and opinions on Divo in the comments down below. If you're still watching and enjoyed, I appreciate a like. Go ahead and subscribe for future content, and I'll see you guys in the next one.